Good morning and welcome back to Almus Market Mornings. This weekend was all about peace talks in the backdrop of the meeting between President Trump and President Putin. There are various reports on what was discussed, but we know for sure an immediate ceasefire was not agreed upon. Today there will be another meeting with President Zelensky along with the coalition of willing, which includes European Union and the UK. President Zelensky will be flying down to Washington on his first visit since his infamous White House meeting in February. All of this seemed to overpower a surprisingly hot PPI, which beat everyone's expectations. Good morning, JK. What are we making out of the weekend's developments? And I would also like your thoughts on the hot PPI as well.
Good morning, Swaraj. Yeah, I think the meeting did not come out with any tangible result, but both the leaders seem to be kind of optimistic about the eventual outcome. Yes, there's lot more distance to be covered. Now, one thing that struck me was that Putin has clung to his maximalist demand for ending the war and announced no concessions on the battlefield. Now, that is something we have to see what reaction would come from Zelensky and European leaders. Obviously, they are not going to accept it straight away. And I think there could be more diplomacy among all the leaders, and then some give and take before we can expect some real outcome. Um, I think I keep my fingers crossed, although optimism is definitely higher than what it was at the beginning of last week. Now, for India, of course, it was suspense that did not end. Because until there is a decision on this, the 25% additional tariff as a penalty for importing Russian oil continues. As far as the US data is concerned, the PPI number was definitely hotter than expected on all grounds, be it the month-on-month, year-on-year core, and the headline. Apart from even the PPA control group, which is also something that reflects in the core PCE number end of the month. So all these things actually would gives a feeling that ultimately the imported inflation is, or rather the higher tariff induced inflation is reflecting in the wholesale prices. Now the point is how fast or how soon it is going to get passed on to the customers, and how much it will reflect in the core PC number, which Fed weighs a lot. The import prices also showed a higher number last week. Now, market has not reacted much to this, particularly in view of the fact that the September rate cut probability is still above 90%, although not a 50 basis points cut as Besant would like to have, but market is not giving up on that, possibly because in July, possibly many people would have expected some sort of a change, but that did not happen. And despite job numbers being very poor, so that is the thing that Fed is expected to balance, weakening job market and inflation, which is definitely looking up in some sort. Although CPI number was not as hot, but it could eventually reflect if the wholesale prices are passed on to the retail level also. So other than that, the US data on retail sales was strong. That is also another reason why the markets were not moving much on the yields, because PPI was higher and the retail sales was also strong. At the same time, we had the industrial production, which gave some sort of a downbeat picture, and the Michigan survey showed consumer sentiment dropping. At the same time, inflation expectations for 1 year and 5 year also rose. So it's a mixed picture, and amid all this, market thinks that Fed will eventually give more weightage for the slumping jobs market, and that's why the September rate cut probability has not been given up. That's where even the dollar is also keeping itself on the weaker side of the range. Though it did gain immediately after the PPI number, subsequently it has gone down uh, to where it was before the PPI number. After this, data on Friday showed the sentiment dropping and the September rate cut probability remaining also higher. Among other regions, we also had growth numbers in UK and Japan coming much better than expected, but the Chinese data was all across lower, and that gives rise to expectation of more stimulative measures from China. And Eurozone industrial production also came much lower at minus 1.3% versus 1.1% in June. This also gives rise to a feeling that the rise in the second quarter was mainly driven by the front loading of industrial manufacturing ahead of the tariffs coming into play. So the dollar basically has been in the range, but on the weaker side. It doesn't show any urge to correct itself higher, and perhaps it is now more on a time consolidation than on a price consolidation. Of course, the uh, strength is concentrated, rather the weakness is concentrated in a few majors like Euro, Japanese yen, and GBP, while the commodity currencies are still on the slightly weaker side, and Chinese yuan is really not making any headway either side of the range. Now, for India, it has been a crucial weekend and also leading up to the weekend because we had quite a few developments that we are seeing. First of all, it was the trade data, trade numbers that showed a big jump in the deficit. From around 18 billion to 27 billion, and big rise in imports during the month of July, both on gold and oil. Services exports also was somewhat slightly lower, all of it leading to overall deficit, including goods and services, to 11.72 billion versus 3.52 billion. Now, if the rising trend in imports persists, then we are going to be in a much more difficult position as far as the trade balance is concerned, because we are going to see some hit into our export due to US tariffs. The other weekend news on the Russia-Putin meeting also without tangible result. I think there is no immediate relief on the additional tariff of 25% on India. At the same time, much bigger negative was the planned visit by US trade negotiators to New Delhi on 25th August has been cancelled, and there is no indication of a new date being fixed. So this means uncertainty on arriving at a comprehensive deal continues, and no relief for the 25% tariff that India is staring at, even without the penal 25% tariff for import Russian import of oil. Now, other than this, we had a couple of positive news for a change. We had S&P upgrading India, long-term sovereign rating from BBB minus to triple B, with a stable outlook. And the agency has considered India's buoyant economic growth, strong fiscal consolidation, credible monetary policy, and low inflation, apart from robust external and financial positions. Now, significantly, the rating agency also noted that US tariffs are manageable, since India's growth is driven primarily by domestic demand. Now, S&P upgrade does not really directly impact the currency, because I think markets are more concerned with other challenges. Now, other important development as far as India was concerned was the changes in uh, the Goods and Services Act, where there has been quite a bit of rationalization and simplification that has been made. Now, the net effect is that 99% of the items currently in 12% bracket shifts to 5% rate, and 90% in the 28% bracket rate to 18%. Now, the implication of this is that you can expect consumption to improve, and that can have some push up on the GDP. So now, what happens is that if there is a hit to GDP due to the exports falling as a fallout of the tariffs, that can be made up partly by the increased domestic consumption also. Yes, this is not again a boost to the currency, but definitely it can boost the sentiment in the stock market. which already shows some signs of stability. So a host of factors for India, and on the whole, currency remains in the range, not really reacting as of now until we see some global factors improving for us. Definitely, you might see eventually in a couple of weeks' time the sanctions being removed, but the 25% tariff, I think it's a long way to go. Uh, I mean, there were hopes that by September, October, we will sign a comprehensive trade deal with the US, but now that becomes a matter of not uncertainty, because the trade negotiations are not happening immediately. So rupee will trade between 87 and 88 range. The only thing that can, two things that can keep it from breaking into a new low is, one is the RBI's constant intervention. They are reportedly selling consistently in both onshore and offshore market. Secondly, the dollar index itself remaining weak. The central bank or the market may be hesitant to push it to an undervalued zone unless there is any large outflow. Although in the meantime, we are seeing FI flows continue to be negative as far as India is concerned. So rupee still has to wait. I think it will be a long wait for rupee to get definite direction either on the either side. Thank you.
Thank you, JK. And a lot of developments both on the international front and domestic front. We are seeing some major policy changes that are happening. I think, as JK mentioned, for a lot of the goods which were in the 12% GST bracket, it's shifting to 5%, and for the 28%, it's shifting to 18% for the large chunk of the goods. So a lot of GST simplification which is happening, which is good for domestic consumption. On the positive front, we also had the S&P upgrade of India's credit rating to triple B from triple B minus. But more on the concerning side would be no immediate relief on the additional tariffs. And the planned visit by the US trade negotiators on August 25th has been cancelled. So there is, as of now, no relief for us when it comes to trade. We also had the trade deficit, which showed a jump from 18 billion to 27 billion dollars. Overall, with the goods and services, the deficit was at 11.52 billion. Overall, dollar has weakened towards the end of the week, but still remains in the range. The weakness was seen to be concentrated in the majors. Asians have been range bound. That's it from us today. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.